FHA or conventional, which loan program is right for you? Today, we are going to dive deep into the differences between an FHA home loan versus a conventional home loan. And you'll want to stay till the very end because I have a number one tip and it's really important. Before we get started, can I ask you a favor? Could you please subscribe to this channel? If you're interested in knowing more about home loans, or you know somebody that could benefit by this knowledge, please subscribe and become part of this community. All right, so let's get into this. FHA home loan versus conventional home loan. What are the differences? And do they differ? My answer to you is they absolutely differ. And the way that a lender approaches which program is best is based on what's going on in the specific scenario for each person that we're talking to. So here's some of the differences. FHA is going to allow for more user-friendly credit scoring and life happening to somebody. So if we just start off the bat, credit is a big differentiator between a conventional and FHA loan. With a conventional loan, conforming conventional, meaning a Fannie Mae or Freddie Mac loan, the minimum credit score is a 620. But wait, it's not just about the minimum credit score. With a conventional home loan, the lender is going to run that loan through the automated underwriting systems that are used in home lending today. And if that automated underwriting system does not approve the loan based on the credit profile and the score, then it's highly unlikely that the lender is going to be able to offer a conventional home loan. Whereas with FHA, it's a whole different approach. With FHA, lower credit scores are allowed, but FHA also allows lenders to do what's called a manual underwrite. So again, most lenders are going to try to send that loan, even if it's FHA, through the automated underwriting system. But let's say that the system doesn't approve it, but the borrower meets FHA's guidelines. Most lenders will then allow for a manual underwrite. So it kind of looks like this. It's the old-fashioned, makes sense. Does the borrower meet the lending guidelines for FHA? Are they in a position to be able to repay that mortgage and pay their monthly payments? Do they have the credit profile that FHA dictates? If all of that comes back as a yes, even though the automated underwriting system isn't approving it, on FHA, that manual underwrite is potentially a solution. Whereas again, unconventional, just not going to see a manual underwrite by most lenders in this country in this day and age. All right, so outside of credit, kind of think of it this way. I already said conventional, 620 minimum, period. FHA, not so much. So FHA will allow a minimum down payment, which on a primary residence, single family, condo, townhouse, and even multifamily is a 3.5% minimum down payment. They allow for that down to a 580 minimum credit score, and you might even be able to go below a 580 minimum credit score with more money down. But if we just stay focused on that minimum down, which is what we see today that most people entertaining an FHA loan want, it will allow for that down to a 580 credit score. So difference in just approach from a credit and risk standpoint. Now, as we move into some of the other things, the way that mortgage insurance works between FHA and conventional is materially different, and it's probably the number two difference outside of credit and the credit and underwriting approach. From a mortgage insurance standpoint, here's the scoop. With a conventional home loan, you're allowed to put as low as 3% down. But with conventional home loans, the credit score is going to drive the cost of the mortgage insurance. And with a conventional home loan, that mortgage insurance can drop off the loan without having to refinance it at some point in the life of the conventional loan. However, on FHA, doesn't work that way. If you are putting less than 10% down on FHA, your market value is never going to dictate your ability to drop the mortgage insurance on an FHA loan. That's the way the program is designed. So if we just look at apples to apples, with just mortgage insurance alone, if we have somebody that can qualify for a conventional home loan, and let's say the cost of the mortgage insurance is similar as it would be on FHA, then we would give the pros and cons of each of the programs. With FHA, the cost of mortgage insurance is not driven by the credit score, another big difference. So again, conventional, the cost of the mortgage insurance driven by credit score and debt ratio. With FHA, it's a preset program by FHA, and if you're putting less than 5% down, The factor that is used is 0.55% of the base loan amount. If you're putting more than 5% down but less than 10% down, that cost of that mortgage insurance reduces a little bit to 0.50%. But with less than 10% down, mortgage insurance on an FHA loan is staying on for the life of the loan. What does that mean? Well, here's what it means. It just means that mortgage insurance is not going to drop off in that scenario. So the way you would get out of mortgage insurance if you utilize that type of loan initially when you purchase the house or maybe last refinance, because there are advantages to an FHA loan. The only way to get out of the mortgage insurance, though, would be to either refinance having more than 10% equity in the property. In that scenario, you're carrying mortgage insurance for 11 years, or refinance into a conventional loan if your credit profile and income profile can meet the lending guidelines for conventional home loans. So, it's one of these things that there are so many nuances between FHA and conventional, and working with an experienced lender that can kind of walk through exactly what's going on in your world, not our world, but your world, and all of the nuances, everything from credit. Life happens. Let's face it. It just does. So maybe you've gone through a bankruptcy or a foreclosure, or you had to have a short sale, or there's something that's gone on your credit profile. FHA may be the better loan program for you. But the way you find out about that is by talking with an experienced lender. And on that note, the waiting periods after a life event, i.e. bankruptcy, foreclosure, short sale, they are much lower with an FHA loan when compared to a conventional conforming loan. So conventional conforming loan, post, let's say, a bankruptcy, the waiting period to be able to use a conventional home loan is longer than when compared to FHA. So some of the nuances, I know it's like, all this kind of stuff, but it is important to know that there are differences, and every loan program has pros and cons. It's the nature of how loan programs work. So really the goal here is to kind of figure out what's best for you. Some of the other things to consider are the appraisal process. FHA is very focused on the health and safety condition of the property. Whereas on conventional, they're still focused on that, but not to the level that FHA is. So for example, this is very common here in Arizona, but let's say you're purchasing a home using an FHA home loan, and the fascia board on the back patio, so that's kind of like the wood trim that goes around the back patio, let's say that fascia board is peeling paint. On an FHA appraisal, it's highly likely that the appraiser is going to call out and make sure that that is repainted. So it's going to require that the peeling paint is scraped, that is repainted, and then the appraiser will go back out and recertify that now that property meets FHA's criteria or condition. So that's just an example of a difference you might see between just the appraisal process between FHA and conventional. Another item to note is loan limits. So the FHA loan limit is going to be driven by the county that the property is in. Whereas with Fannie Mae and Freddie Mac, which is what I'm calling conventional home loan financing, that loan limit changes every year and is set forth by FHFA. And currently that loan limit across the country is $766,550. So when compared with an FHA loan might have a lower loan limit, and generally we will see that. So if you're trying to maximize the loan limit, conventional could be a better option for you. So many nuances. And lastly, when we focus on the differences between FHA and conventional conforming loans, loan level pricing adjustments. What the heck is that? What is that? Well, loan level pricing adjustments are a term in the mortgage industry, and it is what Fannie Mae and Freddie Mac surcharge based on certain information that's going into the loan itself. So for example, a certain credit score with a certain down payment based on the occupancy of the home, it will have loan level pricing adjustments that will impact the interest rate and or cost associated with that loan. Whereas on the FHA side, FHA doesn't have loan level pricing adjustments based on, let's say, credit score. And with FHA, you can only utilize the property as a primary residence. Whereas on conventional, you can utilize financing for a primary residence, as a second home, or as an investment property. So again, lots of differences. Now, one thing to note, lender specific. Lenders may have a surcharge for lower credit scores or higher debt to income ratios, even on FHA, when FHA itself doesn't have loan level pricing adjustments. So lots going into this. And my sauciest tip, that number one tip that you absolutely have to know when comparing FHA to a conventional home loan is this. If you are married and you live in a community property state, let's say you're maybe separated and you want to buy the house in your name only. In a community property state, FHA's lending guidelines require that the lender pull your spouse's credit, one, which isn't always easy depending on what's going on in the situation, count their debts post when you got married into your qualifying debt to income ratio, could be problematic depending on the debt load, and three, if you are trying to close on that home prior to a divorce, your spouse would need to sign a disclaimer deed disclaiming their interest in the property, which again, if you're going through the divorce process, could be problematic. Now, we switch over to the conventional side of that equation. Conventional does not require that the lender pull your spouse's credit. None of their debt is calculated into your debt to income ratio. However, if you are in a community property state, their rule is the same in the sense that your spouse, if you're not divorced yet, would need to sign a disclaimer deed disclaiming their interest in the property. For more information about getting a mortgage without your spouse, stay tuned for my next video that will play after this one. Now, which is the best solution for you? Well, honestly, you won't know until you talk with an experienced mortgage lender. So now you know the difference between FHA and a conventional home loan. If you're new to home ownership, or maybe it's been a few years, or life has happened and you just want to kind of do a gut check and figure out which home loan program is best for you, we would love to have an opportunity to talk with you. Our team is licensed in 45 states plus Washington, D.C. So click the link below to schedule your personalized consultation with the KellyZtilowGroup Mortgage Advisor today. Thank you so much for watching, and please don't forget to subscribe and leave me a comment with any questions you have, and we'll be sure to answer them.